Another month, another Vanguard portfolio update. But what crisis do we need to worry about this month? Inflation. Michael Burry is betting big on it. Vanguard has even released a statement all about it. And somehow it's even made its way onto my bathroom scales. It's absolutely everywhere at the moment. So in this video, we're going to have a bit of a sense check on inflation. Firstly, in terms of what does it mean for your investments, how it's actually affected the stock market so far, and then I'm even going to share you some data from Vanguard on what you really need to consider when looking at inflation figures. To wrap it all up, we'll check on how my Vanguard portfolio has fared over the last month, and with all this in mind, share my thoughts on any changes I might be considering going forward. But before we jump into that, I just wanted to give a quick shout out to my patrons of this channel. If you're interested, then there'll be a link in the description below. Membership starts from as little as £2 a month. So let's start with inflation. We can't say it's that surprising after a full year of consistently printing money that we're starting to see inflation come through. What a shock, said absolutely no one. This means the cost of goods and services is starting to increase quicker than we'd normally expect it to. And this isn't through increased demand or increased spending, but an increased supply of money. Meaning that the money we hold doesn't have as much purchasing power as it used to. People talking about inflation being a concern isn't quite a true reflection of what's going on. Inflation is happening all the time. It's the reason why your granddad harps on about the fact that he used to get paid £2 a month and then bought his first house for a tenner. Today, we've learned to expect around about 2% inflation each year due to a wide range of reasons. But the panic we are seeing now is due to the fact that we're seeing inflation far above these normal levels, to the point where some measures have put inflation as high as 0.8% in a single month, which is nearly 5 times higher than we'd come to expect. But what does this mean for investors? Well, you might come to the logical conclusion that it's a good thing if you hold assets. After all, if the businesses that you own are able to charge more for their goods or services, then they should be making more money and their share prices should be going up, right? Well, in one part, you are correct in this way of thinking. In general terms, holding assets like stocks and shares during high inflation is a good thing, as your assets should increase with inflation. But for people who hold on to cash will be severely punished for this, as their £1,000 that they've saved will be losing a lot of its purchasing power over time. The actual panic is what the governments might have to do in response to high levels of inflation. Remember, the stock market isn't reflective of the business world today, but it's what we believe the business world will be like tomorrow. Inflation is deemed too high if it starts to raise above the 2.5% mark, and the main way governments reduce this is by increasing interest rates. So why is this a problem? Well, any debt that is sat on your company's balance sheets starts to get a lot more expensive for holding, which is really going to whittle away at their profits. That's why you'll have seen a large sell-off in companies which are highly leveraged. So you're typically looking at high growth stocks, especially in the tech sector. And then on the flip side, it's actually been a bumper performance for value stocks, such as Procter & Gamble, for example, as they actually don't hold that much debt on the balance sheets. So if you have a portfolio which has a higher level of exposure to tech, then you've most likely not had a very good month. But on the flip side, if your portfolio holds a high amount of value stocks, then you've most likely had a pretty good month. But not all people within the industry feel the same way about the inflation figures. Some are concerned that it actually isn't under control and they think the governments are playing it down. So a good example of this would be Michael Burry, who is actually betting big that inflation is going to be a lot more of a problem than the government's actually currently letting on. Due to the level of interest around this topic at the moment, Vanguard felt the need to publish a report all about inflation, just to keep its customers informed. I'll give you a little bit of a summary here of what they had to say, as it does give an element of calm against the sea of fear-mongering that you're currently seeing across social media. The article was written by Vanguard's global chief economist, Joseph Davis, and he opens up by clarifying the term base effect when looking at inflation. Like any percentage number, the actual increase or decrease doesn't tell you a whole lot. If I told you that I'd increased my ad revenue on YouTube by 75% versus last month, you could be misled to think that I'm absolutely crushing it. But if I didn't post any new videos in the month prior, is it really that much of an achievement? Probably not. Well, for this reason, Vanguard argues that it's incredibly important to clarify the context of the recent inflation figures. At the start of the pandemic, we saw a period of deflation as people stopped spending money due to the stay-at-home orders. So annual inflation was expected to go up about 2.5% in that year, but in actual fact, the opposite was starting to happen as we went into lockdown. As you can see on this chart, the dotted grey line shows a projected path for inflation before the pandemic, and the actual performance in blue. There was initially a massive dip, and inflation has really been trying to play catch up ever since. Even with the recent levels of high inflation, we are still behind where we thought we'd be just over a year ago. The data becomes more fascinating when you look at it when comparing it to the same month last year. Vanguard have mapped it out here on this graph, but the question is it really that surprising that we're seeing inflation so high at the moment when we're comparing it to the same month of last year? It's a bit like me showing that my Vanguard fund of choice is up 45% since this time last year. It is a fact that it's up by that much, but that obviously doesn't mean I've made 45% of my investments, as it completely ignores the dip which happened beforehand. On top of this, Vanguard highlights that inflation itself can be inflationary, which I thought was interesting. If people and businesses are expecting inflation, then they might be more willing than normal to pay more for goods and services, which will actually push prices up even higher, meaning that inflation is becoming a bit of a self-fulfilling prophecy. The real question posed by Vanguard was if interest rates were kept low, then it was going to benefit the growth stocks, but if governments needed to increase interest rates, then they could see this will really boost the performance of value stocks overall. If you hold a broad index, then neither outcome should really matter to you, as you'll hold a blend of both value and growth stocks. My advice for anyone feeling a little bit uncomfortable right now in terms of being nervous about what the future holds is that I would spend more time looking at how many shares you have rather than the value of the shares you have. Your portfolio reducing in value since last year or the last quarter shouldn't be a concern. You should be more concerned about if you're growing the number of shares year on year in your portfolio. So focus on growing your share of the pie rather than getting caught up on how much your piece of the pie is worth overall. Anyway, that is enough about inflation for today. But before I jump into my portfolio update, if this is the first time you might have considered the base effect when it comes to inflation, then feel free to drop a like on this video, as it really does support my channel. Thank you. So, into the portfolio update. Let me just give a quick recap for any new viewers. My fund of choice is a FTSE All-World UCITS ETF. If you want to know a bit more about why, I'll put a ribbon in the top right, but I've been investing into this since about January 2018. So last month, we were pretty much sat at an all-time high of 83.75, following a further 12% increase in valuation since the start of the year. And this is ignoring the 9% growth we saw in 2020, even with a pandemic in the middle. In terms of where my account was up to, it had crushed its way through 56k. I think it was about £56,474, which is a massive jump from the month prior. Before this, it had been bouncing around the 49k, 52k mark for pretty much the whole year. This large jump last month saw my gains cross the £12,000 mark for the first time, which is a really nice touch, which was incredible considering I was down about £3,000 at the very bottom of the pandemic last March. Well, this month has pretty much been a V-shape. As soon as the inflation figures came out for the US, the price of VWRL dropped from its peak of about £84 quickly down to about £80. As the market readjusted to the news, money flowed out of the growth stocks within my portfolio and then flowed into the value stocks into my portfolio. As this money moved around, my price slowly recovered through the month and actually ended up around about the £83 mark, so only less than 1% down from where it was last month. This downwards movement on the price has pushed the valuation of my account down, but not enough for the impact to be visible due to my direct debit that I put in each month. As some of you know, I actually increased my direct debit this month from £700 to £890 due to my decision to reduce the amount I was going to put into my company pension. If you're interested in knowing why I have done this, then I'll put a video in the top right. The movement of the share price, coupled with my direct debit, has brought my account to a total valuation of £56,881, so not much of a movement since last month. My total gains have moved backwards a little bit from £12,100 down to about £11,700, so not a lot to cry about. I've got to say, I'm still really happy with my investing strategy. It's all about dollar cost averaging into a broad global index, and the only change I'm looking to make over time is actually investing more when I can afford to do so. Outside of the odd sales bonus I might get from time to time, the next time I think I can sustainably move my direct debit up is actually when I've finally paid off my student loan, which I don't think will be to the start of next year. I would be interested to know though how your portfolio's performed over the last month. I imagine if you're heavy into the growth stocks, it might have been a bit of a grim month, then actually if you're heavy into the value stocks, then you might have actually had a really, really good month. Anyway, that's all for this video. I'll see you in the next one.